What's going on, Dividend Chasers? Dividend Bloodhound here with another investing episode. In this episode, we're going to complete my little mini series on undervalued stocks. Today, we're going to talk about 3 undervalued French stocks that are available on your Trading 212 app and, of course, the French stock exchanges. If you like what you see in this video, please don't forget to hit the like button in the corner there and get this video out to even more people. That would be absolutely fantastic. So we can help more people out and get more people investing. If you're brand new here, I'm the Dividend Bloodhound, and it would be fantastic if you hit that subscribe button in the corner there and even ring the notification bell so you get notified when I release brand new content such as this video. So these 3 stocks are undervalued in the market right now, in my opinion, and there's a significant margin to be made on them if you were to purchase in the near future and they return to their original stock price, which, by the looks of these companies, they're all well-known names, should happen over the next year or so at the longest, and maybe even shorter than that in the short term, as demand returns, as we all try and come out of this health crisis in the best shape that we can. That being said, let's get into the first company, and the first company is Total, which is a huge oil and gas and renewable energy company that is obviously of French origin. Let's get in there, let's have a look and start this video off with a roll. Let's go, roll the intro. What's going on again, guys? Welcome to the next analysis part of this video. And as we have already mentioned, we are looking at Total, which is a French-based oil and gas company that operates all over the world, refining chemicals. It has gas, renewable power, production sectors, and makes an awful lot of money when it does so. And it is a significant discount right now because of the drop off in demand from the lack of air travel, lack of cruise travel, and lack of people driving their motor vehicles. Basically because of, guess what? You know it, the health crisis again. Anyway, let's have a look at the fundamentals this company has. So its ticker is FP. It has a market cap of 93.56 billion euros, a PE ratio of 8.66, revenue of an enormous 157.72 billion euros, EPS of 4.13, and a chunky dividend yield of 7.51. Has a net income of 11.27 billion and a profit margin, not quite double figures, but 6.36%, and makes an awful lot of money in doing so. And its debt to assets ratio is pretty low for an oil company, where it has 273 billion euros worth of assets and liabilities 456. Simple maths there. So let's have a look also at its growth rate over the last few years. This is where it might stagnate a little bit because of it being an established company, and that's where you can see there. So growth rate over the last 3 years is minus 3.63%, but revenue over 5 years is actually up 11%. And its dividend growth over 3 years has been 5.26%, which also isn't bad considering at what the yield is currently. And its earnings per share growth is also very positive, double digits there for both 3 and 5 years. So if we get back to having a look at the share price here, so pre-crisis and at the start of the year we were at $50 even, excuse me, 50 euros a share. Peak crisis dropped all the way down to 21 euros a share, absolute steal of a price in my opinion. And we've come back now as demand has started to return up to 35 euros a share. But as you can see, there's still a pretty decent margin in that as we return back to normal. And this company has already, even though it is a big oil company, it is already looking towards the futures. As you can see, it's a energy company, so it's already looking at renewables and lower carbon options, as oil in the future is going to tail off as newer, cleaner alternatives come online. So an excellent company going forward and an excellent dividend payer to make some really good dividend income off in the medium term at least. That being said, I'm going to wrap up there and come out to have a look at the second stock. Catch you back out there. Hello again guys, welcome back to the real world. So that was Total there then, an absolute huge oil giant over in France, paying a really good dividend. And you can also make a decent return on your original investment in terms of appreciation, and somewhere where you might want to put your money if you're not so interested in Shell or BP over here in the UK, or Exxon or Chevron over in the States. Me personally, I have Shell and BP and I'm quite happy with them, but Total is definitely worth considering as well, just for some diversification purposes to get over into France and not being solely British based. But that is completely up to you. Most of these oil giants operate all the way across the world quite globally anyway. It almost just depends on what currency they operate in, really. They're all so global. Our next company that we're going to look at is Danone, and it is a food company over, again, obviously in France, that operates in France but also globally, selling food all over the world. We'll have a look at the fundamentals in a second. Let's get in there. What's going on again guys, welcome to the next part of this video, and here we have the stock Danone. As aforementioned, it's a food based company operating in essential dairy and now towards plant-based products and waters, and also does infant and baby milk, which is also very expensive when I've seen it in the shops. And you'll recognise it from brands such as Activia, Actimel, Aptimil, Nutricia, amongst others. Now then, this stock at the moment is almost half price over the longer term, or should I say not quite half price, 25% off should I say. Yeah, current share price is 65 euros a share. Its ticker is BN. It has a market cap of 46 billion euros, PE ratio of 17.15, revenue of 25 billion, an EPS of 3.83, and a dividend yield of 3.20%. Has a net income of 1.93 and a profit margin of 7%, creeping up towards the double digits there, and a debt to assets ratio of 61%, which isn't too bad at all, nowhere near ringing any alarm bells. It also has a dividend growth ratio doing particularly well, up at 7.3%, approaching double digit growth, which is absolutely fantastic for us dividend investors. EPS growth over 3 years has been 9% and 2% overall. Revenue growth is consistent, shall we say, for 4.8 and 3.6. Growth is growth in my opinion, and to have such an established company still growing is absolutely fantastic. The company doesn't seem to be going anywhere anytime soon, and is exactly why it is staying and is going to earn itself a space in my portfolio. And that being said, I really do want to add this one to my portfolio. I was looking at Nestle, but Nestle gets walloped with a 35% withholding tax from where it's based in Switzerland, whereas the French withholding tax is only at 15%, much like the American withholding tax, which is much more palatable and much more acceptable for such an exceptional company. That being said, let's have a look at the market here. So its current stock price is 65 euros a share, as I've already mentioned. In the middle of the crisis and the crash, you'd have got it for 53, which would have been a pretty decent time to get hold of it, of course. But even now, it is still pretty good, because before it all kicked off, you could have got it for 72, and then just at the end of last year, it was originally at 80 euros a share. So there is some chance that it could eventually return back to that. but for such a good dividend payer, this is a really good discounted rate right now, and I'm definitely looking to add this one as soon as I feasibly can. That wraps us up for this bit, and I'll introduce the third stock shortly. Catch you in a second. What's going on again, guys? That was Danone. Welcome back to the real world. As I think you could see, quite a good company, got some really solid fundamentals in there, a dividend grower, a dividend payer, a healthy looking company with a really good revenue stream, and one that I actually, because my trading 212 portfolio is quite industrially orientated and big pharma orientated, I really want to add like some different sectors in there to diversify a little bit. I'm a bit heavy on the industrial side of things at the moment, so that is something that I really want to get sorted, and I want to do that with either British or European stocks, as this is how my 212 portfolio is orientated. That being said, I'm going to introduce the third stock now, and that third stock is Michelin, which is obviously a tyre producing company over in France, and is renowned for producing some of the best tyres in the world, and it's absolutely exceptional at what it does. But I'm not sure that that's all it does in terms of how it earns its revenue. We'll have a look at that in a little second. So yeah, our last stock today is Michelin. Let's get in there, let's have a look, let's see how it goes. Catch you in there. What's going on again, guys? Welcome to the look and analysis at our last stock for this video. We're looking at Michelin. I'm sure most of you will recognise the little Michelin man on the little tabard there. Huge tyre company that doesn't just produce tyres for cars, of course. It's for bikes, aircraft, trucks and the like. And also they're a technology company. They have branded lifestyle projects and products and produce high-tech materials, as well as the road transportation sectors that they already have. Let's have a look at some of their fundamentals then. So ticker is ML. They have a market cap of 15.83 billion euros, a PE ratio of 8.05, revenue of 24.14 billion, an EPS of 11.03, and a dividend yield still in play at 2.25%. They've got a net income of 1.75 billion euros and a profit margin of just shy of the glorious double digits at 7%. They've got a debt to asset ratio of 58%, well comfortable in my opinion. 31 billion plays 18 billion. And then if we have a look at their ratios, when it decides to let me for whatever reason, it's not working. There we go. Sorry for the technical difficulty there. We have a little look at their 3-year growth and 5-year revenue growth is both at 4%, which is pretty good for an established company. In terms of earnings per share, we got a 12% boost over the last 3 years, which is good, 2% over 5. And then we have a 3-year, this is an area of concern, a 3-year dividend growth rate of minus 14.94%. However, they are starting from a yield of 2.2, but that would be an area of concern that might keep it slightly out of my portfolio for now, based on how that actually works. But you could definitely make some appreciation out of this company even if you weren't in it for the dividends, and the dividends would make a nice happy little bonus for you. As you can see, the share price currently is 88 euros per share. Peak crisis you could have scooped for 72 or 70 euros a share, should I say, and then pre-crisis they were at 112, and they're still some way from that at the moment, though it did show some signs of recovering before the worries of the second wave took hold and everybody bailed out the market all over again. So that being said, I wouldn't buy this one necessarily for the dividend yield, but I'd certainly look to have that in there because you can still make a little bit of money out of it, but it's not, by the look of it, a long-term dividend grower. But you could certainly make some money out of the appreciation in your money, scoop a couple of dividends, wait to make some pretty decent money, and then sell it off and move the money elsewhere. That would be my plan for this one if it if I had the money to make it arrive in my portfolio, or buy it, should I say. I don't know why I was going so beating around the bush with that one. Basically just buy it for my portfolio. It's the lower priority really out of the other two stocks. I would prefer to gain the other two first, in my opinion. That being said, that wraps us up for this video. I'll catch you back on the outside world. What's going on again, guys? Welcome back. 3 French stocks for you there, at least 2 of which I'm looking to add to my portfolio very soon. I hope you've enjoyed the video. Thank you so much for sticking around to the end. Really appreciate the watch time right now. You are helping this channel out massively if you do watch my full videos, and you're not just helping me out, you're helping other people out who will hopefully see some of these videos and start to think about getting investing and diversifying their investments into European companies as well, which I think is good. Diversifying is great. If you haven't already, please tick that like button in the corner there. That would be absolutely fantastic. And if you haven't already subscribed, it would be absolutely glorious if you could, and tick that notification bell as well, so you get notified when I release new content and new stocks like this for you to have a look at and make your own judgment call on. I'll just present you with some hopefully pretty useful information. That being said, this video has been a pleasure to make again. It's been great to see you, and I'll catch you in my very next video. Goodbye.